Throughout the post-World War II era, one currency has stood as the undisputed pillar of global commerce and stability. The United States dollar has served as the medium through which nations conduct trade, store national wealth, and settle international transactions. From the moment emerging economies needed to engage in cross-border commerce to when central banks worldwide accumulated dollars as their most liquid and trustworthy reserves, the greenback maintained an almost unassailable position in the architecture of international finance. Today, however, that position faces unprecedented pressure from multiple directions simultaneously. Countries across every continent have begun taking deliberate steps to reduce their dependence on dollar-denominated transactions, moving instead toward local currencies, regional payment systems, and alternative financial infrastructure that bypasses American-controlled channels entirely. This fundamental shift in how the world conducts economic affairs represents one of the most significant changes to the global financial order in generations. For Americans living ordinary lives, the implications of this shift may seem abstract or distant, yet the consequences will touch nearly every aspect of personal finance, from the prices paid for goods at supermarket checkout lines to the interest rates offered on mortgages and the long-term security of retirement savings. Understanding this transition requires examining both the forces driving it and the mechanisms through which this new multipolar financial world is being constructed. The dominance of the American dollar never emerged accidentally. After World War II, when much of the world lay in ruins and the United States emerged as the sole superpower with intact industrial capacity and technological superiority, the dollar became synonymous with safety and stability. When the Bretton Woods system established fixed exchange rates with the dollar as the anchor currency, international commerce essentially required holding dollars. This requirement persisted even after President Nixon ended the gold standard in 1971. The dollar's supremacy persisted through every major financial crisis of the subsequent decades because markets and policymakers repeatedly concluded that no viable alternative existed. The euro, despite initial expectations when it launched in 1999, failed to dislodge dollar dominance. China's tentative efforts to internationalize the renminbi made minimal progress in reducing the world's reliance on the greenback. The dollar's position seemed almost permanent, embedded so deeply in the infrastructure of global finance that alternatives appeared impractical rather than merely inconvenient. Foreign central banks hoarded dollars because virtually every major economy did so. Corporations invoiced international transactions in dollars because that's what their counterparties expected. Oil producers demanded payment in dollars because global energy markets operated in that currency. This created a self-reinforcing cycle where dollar usage seemed inevitable and immutable. Yet beneath this seemingly stable surface, structural forces were accumulating pressure that would eventually crack the dollar's monopoly. The first such force emerged from geopolitical tensions and the deliberate weaponization of financial infrastructure by the United States and its allies. When Western nations imposed sweeping sanctions against Russia following the 2022 invasion of Ukraine, policymakers froze nearly $300 billion in Russian foreign reserves and disconnected major Russian banks from SWIFT, the secure messaging system that underpins most global financial transactions. This action sent a profound message to every non-aligned nation observing from the sidelines. Governments realized that their dollar reserves and dollar-denominated assets could be seized or restricted without their consent based purely on foreign policy disagreements. Countries holding dollars no longer viewed those assets as a neutral store of value, but rather as a potential liability dependent on maintaining acceptable relations with Washington. The weaponization of the dollar created an urgent motivation for developing alternatives. If dollars could become inaccessible or frozen during international conflicts, then prudent financial planning required reducing dollar exposure. This geopolitical shock accelerated initiatives that economists and policymakers had been discussing theoretically for years, but had never implemented with urgency. Suddenly, the theoretical benefits of currency diversification became concrete necessities for national financial sovereignty. A second force driving de-dollarization flows from the natural economic rise of alternative power centers. Over the past 30 years, the United States' share of global economic output has gradually declined, while China, India, and other emerging economies have grown substantially. The economic size that once supported dollar dominance has become less overwhelming. China now stands as the world's second-largest economy with an increasingly sophisticated financial system. India has overtaken Britain and France to become a major economic force. Brazil, Indonesia, and other developing nations have grown from economic peripheries into significant players in global trade. As these economies have expanded their share of worldwide commerce, their governments and central banks have become more confident in their ability to conduct transactions using their own currencies, rather than intermediating everything through dollars. China particularly has invested enormous resources in internationalizing the renminbi, establishing networks of offshore clearing banks, negotiating currency swap arrangements with more than 30 foreign central banks, and building infrastructure to support yuan-denominated transactions. The People's Bank of China launched the cross-border interbank payment system as a direct alternative to SWIFT, a system that now connects thousands of banks across more than 100 countries. These infrastructure investments represent Beijing's long-term commitment to making the yuan a genuine alternative to the dollar rather than merely a supplementary currency. The mechanisms through which de-dollarization is actively occurring have multiplied dramatically in recent years. The most visible example involves the BRICS alliance, a coalition comprising Brazil, Russia, India, China, South Africa, and newly expanded membership, including Saudi Arabia, the United Arab Emirates, Iran, Egypt, Ethiopia, and Argentina. These nations have collectively abandoned the pretense of pursuing dollar-dependent trade arrangements and instead explicitly coordinate to reduce dollar usage. Russia and China now settle the vast majority of their bilateral commerce in yuan and rubles, bypassing the dollar entirely. Brazil and China signed explicit agreements to conduct their trade in Brazilian real and Chinese yuan. India has created a sophisticated system of local currency settlement accounts, allowing dozens of nations to trade directly in rupees without requiring either party to hold or convert dollars. Argentina recently utilized its bilateral currency arrangement with China to pay International Monetary Fund debt service using yuan rather than dollars, a symbolic moment demonstrating that even payment obligations traditionally settled in dollars could now be arranged in alternative currencies. Beyond these bilateral arrangements, BRICS has developed BRICS Pay, a digital financial settlement platform designed to streamline cross-border transactions among member nations while advancing their collective independence from dollar-dependent systems. The Shanghai Cooperation Organization, a parallel alliance that includes some BRICS members plus Russia, Afghanistan, and Central Asian republics, conducts 97% of trade among member nations in local currencies rather than dollars. These numbers represent a complete reversal of the pattern that dominated international commerce for 7 decades. Central banks, the institutions primarily responsible for maintaining national financial reserves, have begun redistributing their holdings in ways that would have seemed heretical during the era of unchallenged dollar dominance. The share of foreign exchange reserves held in dollars has declined from 71% at the start of this century to approximately 60% currently, the lowest level in more than 2 decades. This 30-year decline appears gradual on annual timescales, yet represents the largest structural shift in official reserves since World War II. Central banks have reinvested portions of these dollars into holdings of other currencies, with the renminbi's share growing particularly rapidly. Simultaneously, central banks have undertaken an extraordinary accumulation of gold, viewing physical precious metals as a hedge against currency instability and potential financial sanctions. The World Gold Council documented record central bank gold purchases during recent years as emerging market governments shifted away from monetary assets controlled by other nations. This pattern reflects a sophisticated calculation by policymakers that owning gold or foreign currencies other than dollars provides greater independence and lower geopolitical risk than concentrating reserves in the single currency controlled by a potentially adversarial superpower. The Treasury bond market, which for decades has been dominated by foreign investors holding American government debt, has experienced a subtle but meaningful shift in this composition. Foreign ownership of Treasury securities declined from above 50% during the global financial crisis to approximately 30% by early 2026. While this decline remains partial and doesn't suggest imminent abandonment of treasuries, the trend indicates that foreign central banks no longer view American government debt as the natural repository for national reserves to the degree their predecessors did. This shift reflects both the rising returns available on alternative investments and the growing concerns about the United States' fiscal trajectory. The consequences of this de-dollarization on American prices and inflation represent perhaps the most immediate way this global shift touches ordinary household finances. As international demand for dollars declines, the currency's value in foreign exchange markets faces downward pressure. When the dollar weakens relative to other currencies, imports become more expensive for American consumers and businesses. The United States imports enormous quantities of electronics, textiles, machinery, pharmaceuticals, and consumer goods from nations across Asia, Europe, and Latin America. Every import priced in its currency of origin, whether euros, yen, or yuan, becomes costlier when converted to dollars. These higher import costs eventually reflect in retail prices for everything from smartphones to automobiles to medications to clothing. During the period when the dollar was notably strong, American consumers enjoyed what economists call an exorbitant privilege, the ability to import goods from around the world at comparatively favorable prices because their currency commanded a premium in foreign exchange markets. As dollar strength recedes in this new multipolar monetary order, this privilege erodes. and prices that had been suppressed by currency advantages begin rising. Furthermore, when imported goods become more expensive, inflationary pressures emerge domestically as retailers adjust pricing and as supply constraints develop when foreign suppliers become less competitive. The Federal Reserve faces a challenging policy environment where the source of inflation stems not from domestic monetary excess, but from structural shifts in international currency valuations. Traditional monetary policy tools become less effective at controlling this type of externally driven price pressure because restraining domestic money supply cannot directly influence whether other nations choose to accept dollars or demand alternative currencies for settlement. Interest rates offered to American borrowers and the government's own cost of servicing the national debt represent a second dimension of impact from declining dollar dominance. For decades, the United States benefited from extraordinarily low borrowing costs because the world's governments and investors viewed Treasury securities as the safest possible asset. Foreign central banks accumulated treasuries as a core holding in their reserves. International investors sought Treasury returns as the risk-free baseline for all other investment calculations. This created steady, substantial demand for American government debt, even when the United States ran persistent budget deficits, allowing the Treasury to borrow vast quantities at favorable interest rates. As the dollar's international role diminishes, this underlying demand structure shifts. Foreign investors no longer view Treasury holdings with the same priority. Central banks that previously accumulated treasuries to manage their dollar reserves instead diversify into other assets. Private investors from nations pursuing de-dollarization look for opportunities outside dollar-denominated assets. With reduced foreign demand, the Treasury must attract additional domestic buyers or offer higher interest rates to incentivize sufficient purchasing. The Congressional Budget Office projects that average interest rates on federal debt will remain elevated for the foreseeable future, precisely because traditional demand for treasuries from foreign official institutions has diminished. When the government must pay higher interest rates to attract buyers for its debt, those borrowing costs ripple through the entire economy. Consumer borrowing rates for mortgages, automobile loans, student loans, and credit cards all anchor to Treasury yields and prevailing interest rates. Higher government borrowing costs translate directly into higher consumer borrowing costs. A middle-class family seeking to borrow for a home faces substantially higher monthly mortgage payments than would have been required during the era of super low rates driven by abundant foreign demand for treasuries. This hidden impact of dollar dominance decline operates silently through financial markets, but profoundly affects household economics. For investors holding stocks, bonds, or retirement accounts, the diminishment of dollar dominance creates both risks and opportunities depending on how investment portfolios are structured. As the dollar weakens, American equities held by foreign investors become less attractive because the investment returns, when converted back to foreign currency, are reduced by currency depreciation. Foreign capital, which constitute a meaningful share of demand for American stocks, particularly in the technology and financial sectors, begins flowing toward assets denominated in stronger or more stable currencies. This capital outflow exerts subtle downward pressure on American equity prices. Simultaneously, the income returns on bonds become less certain as interest rates adjust to reflect changing demand conditions. Investors, who hold significant domestic-only portfolios concentrated in American dollars and dollar-denominated assets, face subtle erosion of their purchasing power over extended periods as the currency's international value declines. Those who hold diversified international portfolios or assets denominated in currencies experiencing appreciation benefit from the reallocation. Americans traveling internationally face the most immediate and noticeable impact as the dollar buys less foreign currency than it did during the era of unchallenged dominance. A vacation to Europe or Asia becomes measurably more expensive as each dollar buys fewer euros, yen, or yuan. This isn't merely an inconvenience for tourism, but affects business costs for companies operating internationally, exchange rates for remittances sent back to family in foreign countries, and the ability of American companies to compete internationally when pricing in foreign markets. The infrastructure through which this new multipolar financial world operates represents a remarkable achievement in systems engineering and international coordination. The M-Bridge project, spearheaded by central banks including the People's Bank of China, Hong Kong's Monetary Authority, Thailand's central bank, and the UAE's central bank, with support from the Bank for International Settlements, represents one such alternative infrastructure. M-Bridge is a digital settlement system allowing multiple central bank digital currencies to interact and settle transactions, effectively creating a multilateral payments mechanism that doesn't require any single dominant currency. Multiple nations have begun pilot testing their own central bank digital currencies as alternatives to the dollar-dependent SWIFT system. If and when these digital currencies mature into operational systems with meaningful liquidity, they would enable settlements between nations without requiring either party to hold or convert dollars. This transition resembles shifting from a hub and spoke financial network with the dollar at the center to a mesh network where multiple currencies can interact directly without intermediation. The Chinese cross-border interbank payment system operates independently of SWIFT, and, as of early 2026, connects more than 1,400 banks across over 100 countries. Smaller nations have begun preferring CIPS for transactions because it avoids exposure to American sanctions and control. What began as a system primarily servicing Chinese trade has evolved into genuine infrastructure serving the broader goal of reducing reliance on dollar-dependent systems. In Southeast Asia, member nations of the Association of Southeast Asian Nations agreed in 2025 to develop frameworks allowing settlement of transactions in local currencies, essentially enabling trade throughout the region without using dollars. These parallel systems, though still smaller than SWIFT and not yet handling the volume of dollar-based transactions, represent the skeleton of the financial infrastructure that would support a genuinely multipolar monetary order. The transition toward this multipolar system will not be instantaneous or complete. The dollar maintains significant advantages that will sustain its relevance for years or decades, even as its dominance recedes. American financial markets possess unmatched depth and liquidity. The quantity of dollar-denominated assets available for investment dwarfs comparable quantities in alternative currencies. The United States maintains sophisticated regulatory frameworks governing its financial system. American institutions hold substantial reserves and operational capacity. These structural advantages mean that even as de-dollarization accelerates, the dollar will continue serving important roles in global commerce and finance. The Chinese renminbi, while expanding its usage rapidly, still faces constraints on convertibility and availability of yuan-denominated assets that limit its ability to fully displace the dollar. The euro has failed to achieve dominance despite being the reserve currency of a large, wealthy economic bloc. No alternative currency currently possesses the combination of liquidity, availability, and stability to completely replace the dollar in the near term. Instead, the world is transitioning toward a system where multiple currencies coexist, each serving specific roles and regions, with none holding the overwhelming dominance the dollar once possessed. This pluralistic monetary system offers benefits and risks. For the United States, losing some international monetary dominance represents a meaningful erosion of what economists call the exorbitant privilege, the ability to borrow at favorable rates, import goods at advantageous prices, and conduct financial operations in one's own currency without constraint. This privilege has underpinned American prosperity and financial flexibility for 7 decades. As it diminishes, the United States must adapt to a world where its currency is important but not paramount, where access to global capital markets cannot be taken for granted, and where financial power flows more evenly across multiple centers, rather than concentrating in New York and Washington. For ordinary Americans, the practical implications of this monetary transition extend far beyond currency exchange rates or international capital flows. Prices for imported consumer goods will likely trend higher as import costs rise in dollar terms. Interest rates for mortgages, auto loans, and other consumer debt will probably remain elevated as the government's cost of borrowing rises. Retirement savings held in dollar-denominated assets may experience reduced purchasing power over extended periods. Travel and international business will become more expensive, yet simultaneously, American exports may become more competitive internationally as the dollar's value adjusts downward, potentially supporting job creation in manufacturing and export-oriented industries. Adjustments in how global commerce is organized will create disruptions and dislocations as established patterns change, yet also present opportunities for adaptation and innovation. The American economy retains tremendous strengths, including innovative capacity, institutional stability, demographic vitality, and access to capital that suggests the nation will navigate this transition without catastrophic outcomes. The most likely scenario involves decades of gradual adjustment rather than sudden crisis, with the dollar remaining important while no longer singular in dominance. During this extended transition period, policymakers and individual households will need to adapt to an economic environment where the currency's international role is smaller than it was during the post-war era, where investment in diversified assets carries greater importance, and where the costs of government borrowing and consumer credit gradually increase to reflect new market realities. This new multipolar financial world is not predetermined by immutable economic laws, but rather represents choices by nations seeking greater financial independence, and choices by markets responding to shifting supply and demand for various currencies. Understanding these forces allows households and investors to make more informed decisions about financial planning, career development, investment allocation, and saving strategies. As the century unfolds in an economic order fundamentally different from the one their parents and grandparents knew,